2026, the world crossed a quiet but historic threshold, without speeches, without ceremonies, without headlines screaming in panic. China reduced its holdings of US government debt by more than $688 billion. On paper, it looked like a portfolio decision. In reality, it was something far more powerful. It was a shift in leverage. In 2026, China made a decision that weakened America's financial gravity. In 1923, the British Empire made the exact same decision, and within one generation, global power permanently shifted. So the mystery isn't what China did. The real question is, how did we arrive at this exact moment? Because history has witnessed this precise sequence before. Again, and again, and again. Empires don't fall from invasion first. They fall from mathematics. They fall from debt. They fall from confidence. This isn't theory. This is 2,600 years of monetary history. Power never vanishes. Power relocates. To understand what is happening now, we have to go back to the first global empire that learned this lesson the hard way. Rome. In the year 117 AD, the Roman Empire stood at its absolute peak. It controlled over 5 million square kilometers of territory. More than 65 million people lived under Roman authority. Roman roads connected continents. Roman law governed trade. Roman currency moved across the known world. The denarius wasn't just money, it was trust. But Rome's power came with a cost. The military expanded. The bureaucracy grew. Public projects multiplied. And eventually, the tax base could no longer support the size of the empire. So, in the year 64 AD, under Emperor Nero, Rome made a subtle but fatal decision. It reduced the silver content of its main coin. Originally, each denarius contained about 4.5 grams of silver. By the year 200 AD, it contained less than 2 grams. By 270 AD, it contained under half a gram. The coin still looked the same, but the value had been hollowed out. This is the first stage of every imperial collapse. Stage 1. Financial stress. Rome printed value into existence instead of earning it. Prices began to rise. Soldiers demanded higher wages. Taxes increased. Merchants lost confidence. The economy slowed. By 284 AD, inflation had spiraled so badly that the government imposed price controls across the empire. That is always the second stage. Stage 2, intervention that worsens the problem. Edward Gibbon wrote, "The decline of Rome was the natural and inevitable effect of immoderate greatness." Within 50 years, Rome lost economic control, and when the economy fractured, the borders followed. The empire didn't fall from a single battle. It collapsed because the system that supported power stopped functioning. Now move forward more than 1,000 years. In 1588, Spain stood at the center of the world. It controlled Europe, the Americas, and global trade routes. Silver flooded in from the New World at over 180 tons per year. Spain should have been the most stable economy on Earth. Instead, it became addicted to debt. Spain financed wars with borrowing. It funded its empire with loans. And by 1600, Spain's debt exceeded 60% of its entire economy. Spain declared bankruptcy in 1557, then again in 1575, then again in 1596, and again in 1607. Same pattern. First, financial stress from overreach. Second, debt expansion instead of reform. Third, collapse of confidence. Rome took 3 centuries to decline. Spain unraveled in less than 100 years. The pattern accelerated. Now, jump to the 20th century. After World War I, Germany was forced to pay 132 billion gold marks in reparations. The government didn't have the money, so it created it. In 1921, $1 equaled 75 German marks. In 1922, $1 equaled 7,000 marks. By November 1923, $1 equaled 4.2 trillion marks. The currency became meaningless. Savings vanished. Wages were paid twice a day. People burned money for heat. Within 5 years, Germany's political system collapsed. Different centuries, same mathematics. Rome, Spain, Germany. 3 empires. 1 sequence. Debt, overload. Monetary distortion, power shift. This is not coincidence. The pattern is mathematically consistent across centuries of documented cases. So now we return to 2026. Let's compare the metrics. Rome's silver fell below 20% before collapse. Spain's debt passed 60% of GDP. Weimar Germany's currency lost over 99.999% of value. Now the United States. US debt to GDP has crossed 125%. Total federal debt now exceeds $35 trillion. In 2010, China held $1.3 trillion in US Treasuries. By 2026, that number had fallen by $688 billion. That is not a coincidence. That is a power recalibration. If we place America on the historical timeline, it is not at the beginning. It is not. At the end, it is in stage 2. And remember the question from the beginning. How did we arrive here? Because the same 3 phases are unfolding. Phase 1, debt overload through spending. Phase 2, monetary intervention. Phase 3, foreign exit and power rebalancing. In the last 5 years alone, 3 events mirror history perfectly. Massive stimulus spending, currency expansion, foreign creditors reducing exposure. According to the International Monetary Fund, reserve currency dominance erodes when debt credibility weakens. History doesn't repeat, but it rhymes with precision. Most people won't see this pattern until it appears in retrospective analyses. But if we understand the historical precedent, the next phase becomes predictable. So what happens next? History shows 3 possible paths. Path 1, rare stabilization. About 10% of empires reform fast enough to preserve influence. Path 2, gradual decline. About 70% experience slow power transfer over decades. Path 3, disorderly collapse. About 20% lose confidence rapidly and permanently. Which path unfolds depends on timing, discipline, and reform. Most observers won't recognize this pattern until it is irreversibly. But you now understand what 90% of people will miss until historians write it down. This isn't about fear. This is about awareness. Power never disappears. It only changes hands. If you want to understand these patterns before they unfold in real time, subscribe. New historical analysis every week.